Good morning and welcome to 3 Minutes on Markets and Money. Today's Technically Speaking post is talking about the golden cross. And of course, this is when the 50-day moving average crosses above the 200-day moving average, which historically is a bullish signal for markets. It actually does a couple of things. First, it tells you that the momentum of the market is certainly positive and that asset prices are rising. And that's why the 50-day moving average, the shorter term average, which is the average price over 50 days, has now crossed above the average price of the last 200 days. And of course, you know, the average price for the last 200 days has pretty much been flatline here because that runs back into the pandemic back in March. But as we are going through this now, the price appreciation in the market is now bringing that 50-day moving average up. So yes, it does represent rising asset prices. The second thing it does, it also provides additional support. We've talked about moving averages in the past. They're a lot like gravity. When prices get too far deviated above or below a moving average, prices tend to return back to that average as a function of how math works. An average is the average price, which means prices have to trade both above and below those averages over a period of time to make it an average. And so this is why these moving averages provide good support. So right now, downside support to the market really is formulated right around 3,000, 3,030 on the S&P, which is where these two kind of moving averages collide at the moment. So there's lots of support here, but there's also been, as of late, a bit of resistance here at these June highs where the markets have kind of run up here. We failed yesterday at those June highs, keeping us really within this consolidation range that we've seen here over the last couple of months. So again, the markets are going to have a bit of work to do here, but if they can break out above these June highs here, that does set the market up to retest all-time highs in the market. With earnings season coming in right now, and again, we're about to see a lot of better than expected earnings because we've lowered the bar so much that, you know, there's real potential here for the markets to rally higher in the short term. And again, not taking that away. But at some point, we're going to have to deal with some of the fundamental issues of the market in terms of valuation, revenue growth, those type of things, which are non-existent at the moment. We've still got to deal with the fact that we've got 50 million people unemployed, slow economic growth, etc. That's all going to weigh into these earnings eventually. And again, the important thing here for earnings season is going to be what companies say about forward guidance for their earnings, is much less so what they're actually reporting for earnings currently. I do want to show you one other thing though, because not always when you see a 50-day moving average crossover that it means it's immediately bullish for stock prices and that you should jump all into the market. There are plenty of cases where in the short term, by the time that you get a crossover these moving averages, asset prices are pretty extended or what we call overbought on a short-term basis. So even though you're getting the cross, it doesn't mean that you can't have a pullback in prices, at least temporarily. In fact, we saw this previously back in 2015, 2016, where the markets actually broke the 50-day moving average. We had the crossover early on in December of 2015. This is when the Federal Reserve first started talking about removing support from the markets, reducing QE. And then the markets rallied immediately back and, in fact, almost set a new high before actually failing again. And this is where we were worrying about Brexit. Janet Yellen reached out, talked to the ECB and the Bank of England, said, hey, we need more QE. And that's what helped the market recover here. But again, we actually had a crossover of the 50-day moving average above the 200-day. And while people thought that that's the all buy signal, I'm in because the 50-day crossed above, we had the golden cross, that was actually a failure here that actually trapped a lot of investors into about an 18% decline very quickly over the next couple of weeks. So again, not always in the short term does it mean that asset prices will be higher, but historically speaking, once you have a confirmed crossover of the 50-day above the 200-day, a confirmed golden cross, it typically does lead to higher asset prices over time. And again, time is always the big issue here. I'm Lance Roberts with 3 Minutes on Markets and Money. Watch your investments. Get by the website, realinvestmentadvice.com. Let us know what we can do to help you. realinvestmentadvice.com.